Welcome back to Tax Tips by the One-to-One Tax Advisor Group. Today, we'd like to talk to you about RRSPs and the Home Buyers Plan and the Lifelong Learning Plan. As you may or may not be aware from previous sessions, RRSPs are a tax deferral tool, allowing you to take money that you don't want to spend today and invest it for use in the future. When you do that, you're able to defer paying the tax on it, normally generating a higher tax refund for you, and choosing to pay tax on the money, preferably at a lower tax bracket when you go to pull out the funds. Now, with the RRSP rules, you are normally required to pay tax on the investments as you withdraw them, with the exception of two situations. And the first one we're going to discuss is the RRSP Home Buyers Plan. Under the RRSP Home Buyers Plan, the federal government allows you to borrow your own money from your deferred RRSP investment account for the purchase of a qualified home. They'll allow you to take out up to $35,000 per person to make the purchase of that home, which means for a family of two, you're actually entitled to take out up to $70,000 to go towards your first-time down payment and other costs associated with purchasing the house. Under the RRSP Home Buyers Plan, you have to first qualify as a first-time home buyer. In order to qualify, you must not have occupied a home that you or your spouse have owned in the previous 4 years, unless you're recently separated. And if you've gone through a separation or a divorce, the 4-year period is waived, providing you're using those investments to purchase a home that you did not live in as the marital home. If you're using it to buy out a spouse or a partner, that home would not be a qualified home. The qualified home must be located in Canada. You must have the intent to occupy the home within 1 year of the purchase date or the completion of it being built. And it must be titled property, which means you have to show ownership on it through land titles. The other option is for persons with disabilities. If you're assisting a person with disabilities to purchase a home, you also would qualify to take money out under the Home Buyers Plan. Another factor that you need to consider when you're participating in the RRSP Home Buyers Plan is the timing. In order to participate, the funds must have been placed inside of the RRSP 90 days prior to the withdrawal. The funds can be withdrawn after the 90 days that it was put in and at any time before the possession date, and up to and including 30 days after the possession date, you're still eligible to withdraw the funds. An offer to purchase should be in place and accepted before you withdraw the funds. And if you had participated in the RRSP Home Buyers Plan previously, you must have your complete repayment done by January 1st of the year that you are participating. So if we look at this situation, let's say that you're planning on buying a house on June 1st. You decide that you've been saving up for quite a period of time, and you decide that you've saved up, let's say $30,000, and beginning of May you say, okay, I'm going to go house shopping. If you took and you deposited that $30,000 in the beginning of May and your possession date was June 1st, you would not be qualified to pull the RRSPs out under the Home Buyers Plan. You'd still be able to pull them out, but the amount would be taxable, and basically you would have just burnt up some of your RRSP contribution limit. So you always need to make sure you're planning it on the 90 days beforehand. So in that case, had you put the money in, let's say by February 28th, you actually would have been able to claim a tax deduction off that entire $30,000, giving you anywhere from $7,000 to $12,000 to $14,000 back as a tax refund in that year. And then after February 28th, by June 1st, you would be able to pull out 100% of the funds, because that's your 90 days. You'd have been able to pull it all out under the Home Buyers Plan and not pay. Now, if you had participated in previous Home Buyers Plan, you would have to declare in the prior year that you paid all of that and do what we call an income inclusion for that year. Providing you file the income inclusion, you're perfectly welcome to take those funds off, because when it comes to repayments, you can repay in advance. Now, let's talk about repayments. Okay, so when we talk about repayment, the repayment period is 15 years after you purchase the house. Okay, it's done in equal payments of 1/15 of the amount used. It's repaid by RSP contributions under your name, and it becomes an income inclusion based on your annual requirement if you don't repay it. Repayments can exceed the minimum repayment, and repayment is actually quite simple. Basically, you're repaying yourself because you're reinvesting back into your RSP. It's not like you borrowed from the bank, you're borrowing from yourself, so you're repaying this yourself. That money will be available for you when you retire. The repayments that are required reduce your current year contributions. So let's take a look at how this works. You pulled $30,000 out in the year 2020. Okay? Your repayment, first of all, is not required until the current year plus 1 year. So if you pull it out in 2020, you don't have to repay it in 2020. You don't have to make any repayments in 2021. But in 2022 to 2037, you will have to make annual repayments. Because you took $30,000 out, 1/15 is $2,000 a year that would have to be put into your RRSP. If you get paid bi-weekly, that works out to $76 a paycheck or $77 a paycheck to cover it off. At the end of the year, you would have $2,000 worth of RSP contributions that you would reduce down to zero in order to claim the repayment. So let's just say you did $100 every 2 weeks into your RSPs. At the end of the year, you would have done $2,600 into your RRSPs. You would report to Revenue Canada that you purchased $2,600, that $2,000 of that was for the RSP Home Buyers Plan, and you would only get to claim an additional $600 in your repayment. However, if you chose to claim the entire $2,600 or repay it all back in 1 year, you're perfectly welcome to do that. Now, we're going to talk about this term that I said, income inclusion. Income inclusions are when you don't make the payment. So what happens if you don't make the payment? Well, quite simple. The annual required payment for that year gets added to your income. So if 1 year came up and you forgot to do your RSP, then what would happen is we would add $2,000 to your tax return as RSP income. That would be considered a RSP income inclusion. And you would have to pay tax on your current tax rate of that $2,000. So if you were in a 33% tax bracket, it would end up costing you $700 in tax dollars to put the money in, versus and you'll never get that back, versus taking the $2,000, investing it for your own future that you will be able to get when you pull back out. So let's look at the benefits of using the RRSP Home Buyers Plan to see who all could benefit and realize a gain from this. So who benefits, or why would you benefit? Well, basically it increases your available down payment by using the tax refunds to add to your down payment savings. It allows separated families that have had to sell their property and sell one home and buy two. It allows them to access extra RSPs to help them get back on their feet. It also helps young people buy homes sooner. With the cost of a new home being well over $400,000 throughout most of Canada, young people need to have $20,000 to $30,000 to meet the minimum first-time home buyers down payment. The RSP allows the Government of Canada to fund anywhere from 20 to 45% of that by utilizing the tax refunds. Well, how do I mean that? Well, let's take a look at an example of YLE. So YLE lives in Manitoba and he makes about $65,000 a year, which means he's in a 33.25% tax bracket. YLE wants to save up for a home and he's planning on saving up $10,000 a year, but he decides to talk to his tax advisor and his wealth management advisor, and they say, you know what, put the money into an RSP. So every year, Wiley puts $10,000 a year into his RSP, and over 3 years, he's put $30,000 into his RSPs. Every year, because he put that $10,000 in, he receives a tax break or a tax deduction of $3,325 because he's now deferring the income on that at his tax bracket. That over a 3 years period of time gives him $9,975. The total available down payment is actually $39,975, or call it $40,000, and that's without investment returns. So we haven't talked about how much money his $30,000 has made and what he reinvested his tax refunds in. So it could be well over 40,000. It could be into the 40, 45 or so. But let's just take a look, and we're only going to talk to $40,000. So he's going to take that out to use as a purchase on a house. Now, when it comes time for him to repay it, it's not like he's borrowing the money from one of the big 5 banks. He's borrowing the money from his own investment. So he's actually repaying his future again. The total government contribution under this situation was almost $10,000, which actually gave him, or the government funded 25% of his home purchase. All right, I hit the button a little too fast there, but let's now talk about the RRSP Lifelong Learning Plan. Very similar to the Home Buyers Plan. You're able to use the RRSP Lifelong Learning Plan to borrow from your deferred tax savings in order to go to school continuing education. You can take up to $10,000 out per year, up to $20,000 throughout your entire lifetime. Okay. The RRSP Lifelong Learning Plan qualifications are: you must have money in an RRSP to take it out. You must be enrolled by March 1st of the following year. So if you take money out in November or December, your school has to have started by March 1st of the following year. You have to be going to school as a full-time student under the HRSDC rules. It has to be a qualified educational program. So in other words, it has to be supported by Human Resource Development Canada. It has to be a designated educational institution, so colleges, universities, and many other community college or specialty schools are qualified as a designated educational institution. You also must be a resident of Canada, and you must not be repaying any previous lifelong learning plan withdrawals. And timing, once again, let's take a look at our timing. In order to participate in the lifelong learning plan, funds must have been again in the RSP for 90 days prior to the withdrawal. You can participate if you're a taxpayer and going to school. If your spouse, right? So here's who can participate: the taxpayer. So you can participate. Your spouse can participate while you're going to school, or the other way around. So if one spouse is going to school and the other spouse has RSPs, they can pull money out of their RSPs to pay for their spouse's school. So therefore, if somebody is going to school, you can actually pull out $10,000 from their RSPs plus $10,000 from their spouse's RSPs, which can give you $20,000 for continuing education in the 1 year tax-free, right? And or both spouses can participate either separately or at the same time. So if both spouses are going to school, you can both take the $10,000 out, or if one spouse goes for a couple years and the other spouse goes, you can take it out. So it's pretty neutral as to how you can take the funds out. But you have to remember that there's a maximum lifetime limit per taxpayer of $20,000 that can be withdrawn. So let's look at the repayment plan. First, with the lifelong learning plan, you're only allowed 10 years to repay it. Again, it's done in equal payments, which are 1/10 of the total amounts withdrawn. It's repaid by paying to the withdrawer's RSP contribution. So if you take money out for yourself, you're the one who puts it in. If your spouse took money out of their RSPs to pay for your school, they're the ones who have to recontribute to their RSPs. Income inclusion rules follow if you don't make your annual payments. We have to include income to the person who is required a repayment. And again, repayments can exceed the minimum amount. And sometimes that becomes a tax planning situation. So if Joe goes to school, takes school, and the following year from school he doesn't work and has no other income, Joe could actually choose to do an income inclusion of the entire $10,000, use up his basic personal exemptions, and not have to pay tax on any of it or be required to put any more money back. So with the RSP Home Buyers Plan and the Lifelong Learning Plan, there are some situations where you can do some tax planning around those withdrawals and the repayments. Now, if we take a look at the repayments are based on this, similar to the RRSP Home Buyers Plan, current year plus 1 year. However, it's not based on the withdrawal. In most cases, the current year is the last year that you have spent a minimum of 3 months in full-time attendance. So if you pulled the money out in 2018 and you finished school in April of 2021, April of 2021 kicks off the current year, so you wouldn't have to repay it in 21, you wouldn't have to repay it in 22, you'd have to start repaying it in 2023. Now, the other option is it's 5 years from your current withdrawal. So, 2023 would be the drop dead deadline on that, because if you pulled it out in 2018, even if you were still going to school in 2024 or 2025, 2023 becomes the repayment period because you had the funds pulled out for 5 years. Hopefully that makes sense. Now, that pretty much covers everything that we wanted to talk about with the RSP Home Buyers Plan and the RSP Lifelong Learning Plan. As always, if you have any questions, if you need any help, that's what our advisor group is here for. We have advisors all across the country that are here to help you. We're here to help you, give you tax advice. We have people within our system that can give you different options for investing in your RSPs, for actually doing some planning on this in advance, because we do have advisors licensed throughout Canada. And we also have internal mortgage specialists that provide, through a good working relationship, provide our clients with some of the best mortgage rates around in case you're looking under the Home Buyers Plan. So how do you reach out to us? Get a hold of your advisor through your one-to-one tax advisor group app, or just visit us at www.onetoonetax.com. Thanks for tuning in. We'll see you again on one of our next tax tips. Have yourself a great day.